Top 10 Best Investing Tips an AI can give you for beginners. Investing in the stock market can seem daunting, especially if you're just starting out. But have no fear, I'm here to provide 10 tips to help beginner investors navigate the world of stocks. With the right knowledge and strategies, anyone can become a successful investor. Grab a notebook and let's get started. Tip 1. Understand your risk tolerance. Before purchasing any investments, it's vital to honestly assess your personal risk tolerance. Risk tolerance refers to how much volatility you are comfortable accepting in your investments. All investing involves some degree of risk, the possibility of losing principal. However, some securities and markets are much riskier than others. The level of risk you choose to take on will determine the asset classes, sectors, and individual securities you invest in. Conservative investors have a lower risk tolerance and are less comfortable with large market swings. They prioritize capital preservation over high returns and tend to favor safer, stable assets. Examples include bonds, dividend-paying stocks, low volatility sectors like consumer staples and utilities, and cash. More aggressive investors have a higher tolerance for risk. They seek higher returns and are willing to accept more pronounced volatility. This may lead to investments in small cap and growth stocks, emerging markets, commodities, and speculative assets. Most beginners likely fall somewhere in the middle, willing to accept some risk in pursuit of reasonable returns. As you gain experience, you can re-evaluate your risk tolerance and potentially include more aggressive options in your portfolio. Understanding personal risk tolerance helps prevent taking on excessive risk that leads to emotional decision-making when markets decline. Take some time to reflect honestly on your finances and psyche when determining how much risk you can handle. Tip 2. Start small and build over time. With investing, it's often better to start small rather than diving in head first with a large amount of capital. This allows you to gain experience without biting off more than you can chew. Rather than trying to hit a home run right away, focus on singles and doubles. Small beginnings compound into something much larger over time. One recommended approach is to utilize dollar cost averaging. This involves investing a consistent recurring amount, such as $100 or $500 per month. The benefits of this strategy include taking advantage of compounding by giving your money more time in the market to work, avoiding the pitfalls of making one large purchase at the wrong time, reducing some emotions by following a disciplined schedule, forcing you to continue investing even during declining markets. As you become more knowledgeable and your savings grow, you can increase the amount invested. Additionally, windfalls like bonuses or tax refunds provide opportunities to make one-time larger contributions. Consider starting an automatic transfer from your checking account to your investing account for a set amount each month. Then stick to your schedule, increasing contributions periodically when appropriate. Tip 3. Diversify your portfolio. Don't put all your eggs in one basket, is timeless investing advice. Diversification involves spreading money across different securities, sectors, industries, and asset classes. The goal is to mitigate risk, since various investments often react differently to market and economic shifts. For stocks, broad diversification looks like owning at least 15-20 stocks across multiple sectors. Some core sectors to consider including are technology, healthcare, financials, consumer discretionary, industrials, and energy. Expansive diversification might involve allocations to international stocks, which behave differently than domestic stocks and provide access to foreign markets. Other asset classes like bonds, real estate, and commodities can also be incorporated. A simple way to achieve diversification is owning mutual funds or exchange-traded funds, ETFs. They provide exposure to hundreds or thousands of individual stocks within a single fund. Index funds, which track market indexes like the S&P 500, offer instant diversification. Don't just haphazardly choose investments. Seek diversification across sectors, market caps, growth rates, and geographic regions. Spreading your money wisely reduces overall portfolio risk. Tip 4. Use index funds for passive investing. Actively picking individual stocks requires research, valuation skills, and constant monitoring of company and industry developments. This can be an overwhelming endeavor for beginners. Index funds offer a simpler passive investing approach. They track and mirror the performance of market indexes like the S&P 500 or NASDAQ. Benefits of index funds include instant diversification spanning hundreds or thousands of stocks, lower expense ratios than actively managed funds since no active stock picking is involved, reduced volatility compared to owning just a handful of stocks, potentially higher returns than the majority of active managers over the long run. Some popular index funds that cover the broad stock market include Vanguard S&P 500 ETF, VU, Fidelity 500 Index Fund, FXAIX, Schwab S&P 500 Index Fund, SWPPX, Vanguard Total Stock Market ETF, VTI. For beginners, index funds can serve as a low-maintenance core portfolio holding offering steady market returns. Actively picked stocks can be added later as your experience grows. Tip 5. Don't try to time the market. Interest rates, economic data, geopolitics, earnings reports, trend lines, valuation metrics. The list goes on. There are endless signals investors try to use to time market tops and bottoms. However, even the smartest expert money managers fail to consistently predict shifts. Market timing involves making changes to your portfolio in an attempt to avoid losses during downturns, or to chase returns during upswings. This results in letting emotions drive buy and sell decisions. The problem is no one can accurately determine peaks and troughs in advance. Perfect timing is more a matter of luck than skill. And being on the sidelines means potentially missing out on gains while waiting for the next opportunity. Several studies have shown that missing just a small number of the market's best single-day gains can devastate long-term returns. The power of compounding works in your favor when invested for the long haul. Rather than market timing, use dollar-cost averaging to invest consistently over time. This helps smooth out market volatility. Focus on building a portfolio of quality companies with the intention of holding for many years. Tip 6. Reinvest dividends for faster growth. Many established companies pay regular dividends, a cash payment per share distributed to shareholders. This provides an income stream on top of share price appreciation. Rather than taking dividend payments as cash, you can reinvest them to turbocharge total returns. This is called dividend reinvestment, or DRIP. Reinvested dividends buy additional shares, which then earn further dividends themselves. This compounding effect causes the value of your holdings to grow much faster over time. Even if share price remains flat, reinvested dividends increase the number of shares owned. Many brokerages offer automatic dividend reinvestment programs. You can enroll eligible holdings in the program and dividends will automatically be used to buy more shares commission-free. If your broker doesn't have a DRIP, you can choose to manually reinvest dividends by purchasing additional shares. This takes a bit more effort but generates the same compounding effect. Turn those dividend payments into fuel for your portfolio's growth engine via the power of reinvestment. As Albert Einstein said, compound interest is the eighth wonder of the world. Tip 7. Hold through market volatility. Stock prices fluctuate constantly, with some days seeing huge ups and downs. In the moment, this volatility can seem alarming or induce impulsive reactionary trades. However, reacting hastily often locks in losses and derails long-term returns. Instead, commit to sticking with quality investments even amidst turbulence. Maintain perspective by zooming out beyond daily swings. For instance, during 2022, the S&P 500 fell into bear market territory with a peak decline of around 25%. But historically, every bear market has fully recovered. From peak to bottom, this correction took 235 days. Yet over the last 50 years, the average bear market has lasted for 10.5 months before recovering. Extended sell-offs test our nerves, but patience pays off. Also, remember that short-term price movements often diverge from underlying company fundamentals. A firm with strong financials and growth prospects becomes worth no less just because of temporary negative market sentiment. Savvy investors view declines as opportunities to buy shares of outstanding businesses at reduced prices. Be greedy when others are fearful, and let the market's manic swings work in your favor. Tip 8. Utilize tax-advantaged accounts. When investing outside of retirement accounts, capital gains and dividends are subject to taxes. This diminishes net returns. To maximize gains, prioritize contributing to tax-advantaged accounts which defer or eliminate taxes. Options to consider include 401k offered by many employers. 401k contributions come out of your paycheck before taxes. This lowers your taxable income while allowing investments to grow tax-deferred. Many companies also offer matching contributions up to a percentage of your deposit. Always take advantage of free money from an employer match. IRA, individual retirement accounts allow making tax-deductible contributions up to annual limits. As with 401ks, investments grow tax-deferred. Traditional and Roth IRAs are available with different tax structures. Roth IRA. Contributions are made with after-tax dollars, but qualified withdrawals in retirement are tax-free. This provides tax-free growth while also creating a source of tax-free income later. HSA. For those with a high-deductible health plan, health savings accounts permit tax-deductible contributions that can be invested and used tax-free for qualified medical expenses. Max out contributions to any available tax-advantaged accounts before funneling money into regular taxable accounts. The tax savings substantially boost long-term wealth building. Tip 9. Don't chase hot trends. When sectors, asset classes or individual stocks are skyrocketing in popularity, it's tempting to rush in hoping to benefit from the surge. However, manias and speculative bubbles inevitably unwind. Rather than chasing the hottest fad, restrain the fear of missing out. Rely on fundamental analysis, valuations, and rational examination of financials. Avoid get-rich-quick schemes promising guaranteed or outsized returns. Many investors were lured into major losses by blindly following peers into manias. Early 2000s tech bubble. Traders piled into internet companies with no earnings. The Nasdaq fell over 78% within 2 years. 2008 housing bubble. Home prices surging on loose credit drew in flippers. Prices ultimately plummeted along with mortgage lenders. 2021 meme stocks. Social media hype pumped up GameStop shares 2,500% before crashing back down. While bubbles can persist for some time, fundamentals eventually matter. When investing, resist following the herd during times of extreme greed or fear. Tip 10. Create an investing plan. With endless opinions, predictions, and opportunities, it's easy for investors to make reactive moves without a defined strategy. This frequently leads to poor timing and emotional decision-making. Creating an investing plan provides a systematic approach based on financial goals, time horizon, and risk tolerance. It serves as a guide during periods of market turmoil that prompt knee-jerk reactions. Key elements of an investing plan include financial goals. What are you investing for? Retirement, education, house, liquidity? Your goals dictate strategies. Time horizon. Are you investing for 6 months or 30 years? Short-term goals warrant different investments than long-term. Asset allocation. What percent in stocks versus bonds versus other asset classes makes sense for your situation? Diversify appropriately. Risk tolerance. Assess how much volatility you can stomach. Higher risk assets offer more potential reward accompanied by larger declines. Contribution strategy. Decide on periodic contribution amounts. Utilize dollar-cost averaging to build positions over time. Withdrawal strategy. Develop guidelines for rebalancing and accessing gains to align with financial needs. Revisit your plan periodically to account for life changes and modify strategies as needed. But avoid deviating every time markets shift or a hot asset emerges. Thanks for watching. I hope these 10 tips provide a solid starting point for new investors looking to dive into the world of stocks. Investing can pave the path to financial freedom, but does require continuous learning and discipline. Be sure to subscribe to my channel for more investing education content from an AI.